Hello and welcome to this third of three presentations on cyber threat management. My name is Philip King Wilson. I'm a visiting scholar at the University of South Florida, Department of Information Systems and Decision Sciences. In this third and final presentation, we'll take a look at alternative algorithms and how they could be used for cyber threat management and valuation. We'll take a practical walk through one particular algorithmic model and how it's used to create a network value at risk. Cloud computing is with us and growing exponentially, and we'll take a look at its operating environment and how it can be creating new threats to our operating environment. And finally, we'll take a look at what is a major tenet of the risk management process, and that's risk mitigation using risk financing. We'll also take a look at the impact of cloud computing on this last and why it may actually start to limit the availability of risk financing as a mitigation option.
So just to recap what we've already discussed in the previous two presentations, we're looking at how we can capture network traffic and analyze it to identify threats to an organization. We also need to map the relationships and interdependencies of business processes and IT systems. Then we take three sources of data and extrapolate to predict the number of new viruses into a future period. In the current operating environment, we're facing two major network security challenges and one for risk financing within cyber threat management. For networks, they are 4G networks with wide availability and cloud computing and a shift towards dispersed operating models. And for risk financing, it's in the form of retrocessional insurance spirals. The risks are major because of uncertainty. So now we're going to use the example of insurance claims as an example to better understand uncertainty as a concept. When we talk about uncertainty and modeling uncertainty, it's important to recognize that there are three different types of uncertainty. The first, parameter uncertainty. The ultimate cost of a claim in insurance terms depends upon a lot of assumptions which can't be known with certainty. For example, we can make our best estimate of the probability that a claim is successfully defended, but we can't be sure that this is the true probability. Secondly, we have process uncertainty. This is recognizing that even if we do know the true probabilities, the reality is still stochastic or probabilistic. This means that we can never know for certain how an insurance claim will turn out in advance. As an analogy for these two types of uncertainty, a coin may be biased, and if we toss it 10 times and it lands 7 times on heads, we can deduce that the probability of a head is 0.7. However, we can't be certain that the probability is not 0.8 or 0.6, and this is parameter uncertainty. By contrast, if we know that the coin is fair and without bias, in other words, there's no parameter uncertainty, and tossed it 10 times, we couldn't be surprised if we got 4 or 6 heads, and this is called process uncertainty. Model uncertainty is the risk that the model chosen is the wrong one. For example, using a linear model for virus growth versus an exponential one. Regression techniques lend themselves very well to modeling uncertainty. Using this method, it's possible to extend regression calculations so we get a distribution for each parameter we wish to include rather than the best estimate of each parameter, and we can also then obtain the correlations between the various parameter estimates. In the previous presentation, we discussed why one particular algorithmic model may be used over another in risk management. But now we're going to look a little deeper into a few models and why they could or could not be used for cyber threat management purposes. First, we'll take a look at Markov models. A Markov model represents the dynamic nature of events in a system as a sequence of conditionally dependent transitions through a finite set of system states. By applying the Markov assumption that successive states of a system depend only on the current state of the system, the Markov model is able to represent the conditional likelihood of transitioning from any state to another state using a simple 2D matrix of transition probabilities, which is referred to as a transition matrix. A sequence of events can therefore be thought of as a probabilistic walk through the transition matrix, and hence prediction of future events is simply provided by the relevant row of the model's transition matrix. If a Markov model were used for modeling cyber threats, then the way it would be used would be to populate the time series extrapolation with the set of states derived from historical data. Each state would contain a value from the time series and then identified by a key. The key is the value of the theta previous data points. Once all the data is added to the model, it can be used for predicting the next future data point by forming the key for that point and looking up the value in the model. So far so good. However, the major problem with Markov models is the sparseness of the data. The states in the model can be visualized as points in theta dimensional space, with each part of the key being the coordinate in one dimension. So let's say that theta equals 10 weeks of data, and this is being used to predict the next value, and each data value can only be one of 8 values. This would mean that there are 8 to the power of 10, so that is over 1 billion possible keys in the model. If we have, for example, 2 years of weekly data to populate the model, then this would mean 100 points being represented, and the chance of a particular key required for extrapolation being present is only 1 in 10 million. So this is normally where this kind of problem occurs. This is normally overcome by using clustering techniques, by grouping according to proximity, so that when a key is looked up for extrapolation, it will fall into one of the clusters, and the average value of the points in the cluster can be used to predict the value sought. In the case of using the model for network attacks and extrapolation, however, the problem of data set size remains because the model requires very large data sets. In the case of cyber attacks, the model space will be so thinly populated that any meaningful clustering would probably be impossible, and the clusters would have very few points each. And that in turn would lead to a high degree of uncertainty in determining which cluster a future point would belong to, and therefore the prediction would also be indistinct. In practical operational terms, the clustering algorithm cannot be demonstrated to a customer or a regulator that it's generating sensible groupings, and so making the justification of using the model is far more complex or even impossible. Furthermore, a last point is that a Markov model also takes no account of random jitters and spikes that could be expected in network traffic data and in threats, since it treats any combination of values making up a key as being equally valid. This would mean that spikes in historical data used to train the model would show up in similar circumstances in the predicted output. With the above being the case, although a Markov model could be used in statistical terms, any possible advantage of using it practically is outweighed by the operational issues it would create. Next we can address Bayesian networks, and a Bayesian network represents the conditional relationships between events and variables of a system as an interconnected network of nodes. It is of an acyclic nature, enabling conditional relationships to be learned and causality relationships to be inferred from historical data obtained from a system. These relationships can then be used to infer the likelihood of an unknown event given a set of observations. Using Bayesian probability, a Bayesian network can also be trained with a priori knowledge provided by a group of experts, and this is known as a Bayesian belief network. Bayesian networks are primarily designed to extract information and predictive capability arising from correlation between unexpectedly related parameters. So here, for example, if it's used for risk assessment in determining probabilities, we can use it for fish spawning and the probability of spawn reaching maturity. However, what's required for modelling cyber attacks on systems and processes is much more of an ability to extrapolate individual data series to predict future values based upon current and old ones, and as such Bayesian beneath networks are really not appropriate for the types of extrapolation that we need. Another model that could be used is autoregression. And autoregression is a refinement of weighted linear extrapolation, which we used in the previous presentation. It differs in that weighting parameters used in modeling with weighted linear are not specified by the user, but instead finds them by calculating which values would have provided the best predictions for historical data. So in practical use, autoregression could be used as part of the overall modelling of cyber threats by using it as a type of pre-processing step for weighted linear extrapolation. We would take a suitable quantity of historical data for each data series being extrapolated and analysed, and we'd find the model parameters. As in the case of Markov models, autoregression requires a greater dataset than for weighted linear extrapolation, although to be fair the increase would be modest if linear weights would be used. So in conclusion, this particular model could be used in combination with weighted linear extrapolation if the desire to remove any bias that comes from permitting a user to determine the weights if present, although the trade-off would be reduced flexibility from a customer perspective and increased explanation of the two models working in combination to regulators. So firstly, we're going to load the company's network attack data and risk files. Once the data is loaded, and this is exactly the same data from the analysis engine as in presentation 2, then we have the graphical output of the historic network virus attack data. On the left of the screen you can see there's a risk hierarchy from the root of variants of particular threats. This enables us to drill down into the types of attacks and see the shifts in historical threat trends, which we can see are substantially different in both the trend frequency and pattern over time for a particular threat. Now we're going to display the risk results graphically as a probability distribution function. You can also see that there's red, amber, green warning light at the top right. For this particular threat the acceptable threshold has not been breached, so it stays green. Now we can load different files and we can see the shift in the distribution, and we can see that a threshold breach turns the warning to red, and this is a simple means of alerting risk managers. Here we can also drill down into the risk hierarchy on the left from the root to the child and grandchild levels to see the effect on the loss distribution. We can also run both a forecast of the network threat attack rates and a simulation of the risk statistics for those threats. I'll take a threat group with a severity of 7 and we can see the various statistical outputs from the model being generated. We'll generate an audit report so we can see the statistics more clearly, and briefly we can work through these. Firstly is the expected loss. Next is the root semivariance. This is akin to the standard deviation, but it differs in that it's computed separately for the upper and lower parts of the loss distribution. The confidence level is for the percentage of level X. So here we have 90, 95 and 99% confidence levels. And finally there is the conditional expected shortfall for each confidence level. This is the expected loss if the loss exceeds the given confidence level of loss, and it's a better measure of risk than the confidence level. Some of the model parameters can also be varied according to the company's requirements. So here we have the defaults for the confidence level, the risk tenor for the relevant time periods, and the model core, which is a Monte Carlo simulation running as a default here 10,000 iterations.
So now we've taken a walk through how Monte Carlo model may be used for cyber threat measurement and network risk valuation. We're now going to move on to cloud computing and try to illustrate in a simple process why Monte Carlo modelling may be the most appropriate form of algorithmic model for modelling cyber threats. Hopefully the quick overview of cloud computing and its environment will make this clear.
In the case of cloud computing, the emerging infrastructure and its use by all size of organizations makes the mapping of process technology interdependency ever more difficult. Examples here are social networking sites used on the same mobile device as that used to access company core systems remotely that are cloud hosted. That is to say, both private and public clouds are interconnected indirectly. The type of cloud and the use of it will impact heavily in the risk assessment. There's also the linking between types of cloud and the types of applications being run by end users as to how the linked risks can vary in exposure value. If we take a look at how the cloud architecture is currently evolving in terms of the three types of cloud service, we see that there is software as a service, platform as a service, and infrastructure as a service. And it's clear that the lower down the stack in this diagram the cloud provider stops, the more security the consumer is tactically responsible for implementing and managing, and this has obvious security implications. Here we have a representation of a private cloud of company X with 3 business units, each with different security, service level agreement, governance and chargeback policies on shared infrastructure. By contrast, here is a public cloud provider with 3 business customers, each with a different security, service level agreement, governance and billing policy on shared infrastructure. Hopefully the security implications are made clear in this latter case, where shared infrastructure makes a vulnerability of one customer having the potential to infect or disrupt another customer that runs within the same virtual machine environment. This is especially the case where an attack affects the security policies in a particular cluster, so the effect of a successful attack is effectively a one-to-many type of attack, and the possibility that thousands or even millions of users could be affected. In this diagram, the ownership, management, access and consumption are mapped to illustrate the variability inherent in cloud computing, regardless of the original intent of the parties. In 1, management includes governance, operations, security, compliance and so on. 2, infrastructure implies physical infrastructure such as facilities, computers, networks, storage equipment and so forth. In 3, infrastructure location is both physical and relative to an organization's management umbrella and speaks to ownership versus control. In 4, trusted consumers of service are those who are considered part of an organization's legal, contractual or policy umbrella, including employees, contractors and business partners. And in 5, untrusted consumers are those that may be authorized to consume some or all services but are not logical extensions of the organization. And hopefully this demonstrates the number of variations within the cloud environment that exist already, and certainly many other options of this schematic will evolve in the near future too. The anatomy of how users can now access data is depicted in this diagram. The application is the window to the data, and the new perimeter is the content or data and context by which the user attempts to access that data. Since applications now determine access to data, applying security controls to the cloud applications becomes critical, and again there's increased scope for a point of failure. So in terms of the changes that cloud computing has delivered, and by that I mean the threat environment, additional classes of testing will need to be deployed and included to address threats that arise as a result of the deployment model of the application in the cloud. The interlinking of tenant systems and processes can arise through data harvested from one being used to compromise another or several others. In terms of cloud security management, this is founded upon user access control in the same manner as been the case for many years, especially in the case of teleworkers and more recently for mobile apps via telephones and tablets and so forth. Access management should, depending upon the business security requirements and the type of cloud model deployed, govern access to firstly the network layer. Without meeting the entitlement rules, it may not even be possible to ping or route to the cloud system, and the entitlement rules may also direct access to particular interfaces. At the system layer, the entitlement rules may define the protocols that are permitted to access and modify systems, such as terminal server versus the web. At the application layer, the entitlement rules may map identity and or attributes to functionality provided by a specific application, such as being represented with a reduced set of menus or options. At the process layer, the entitlement rules can be used to define the processes and functions that can be run within an application. Entitlement may also define that enhanced functions, for example money transfers, require additional verification, typically. And at the data layer, the entitlement rules may limit access to areas of the data and file structure, or even individual files or fields within files, for example in a database. At a more advanced level, entitlement can also be used to auto-redact documents, so that would enable two users viewing the same document to have differing views of it. Field visibility in the database record, for example. This will be a highly attractive option to offer customers, but there's a clear threat of data leakage and or corruption in the event of a successful attack on how the entitlement rules are managed. The key to access control is the identity and attributes of the user and how these are acquired and utilized. The hub and spoke model that's represented above illustrates how the identity and attributes are centrally managed and coordinated by the hub, which then interacts with the cloud service or cloud applications. The hub and spoke approach typically allows the cloud service to interface directly with the organization for its identity and attribute information. The organization's internal systems are responsible for keeping track of users and other entities and the attributes. And a hub and spoke approach is likely to be used when a high degree of control is required over all users with a central enrollment process. So this is more likely in organizations that are subject to heavy regulation. The model may also lessen the dependency on the identity attribute providers, as attributes are often stored or duplicated within a central hub. However, and by contrast, an alternative is the freeform model depicted here, and that has the cloud service application as being responsible for maintaining the sources of identity and attributes. Now, this solution is more suited for a public-facing solution or a solution with a large number of disparate partners. The advantage of the freeform model is the ease of establishment of it. And it's possible to have a hybrid model with a mix of the hub and spoke and the freeform model, and this would offer efficient use of the distribution of resources, but has the risk of becoming complex with the attendant scope for security holes to creep in. So the issue here is one of applicability of the most appropriate access control model for the cloud and users. Will it be the case that there will be a multiple cloud provider who utilizes a freeform model to keep costs and administration low, or will there be some form of regulation imposed upon this new and emerging service sector?
There are two factors that are playing heavily on the cyber threats environment right now. Firstly are smartphones and tablet usage. They've become ubiquitous within a very short space of time, and in fact historically it's the fastest growth of adoption rate of a new technology in history. We can go all the way back to the telephone, the original television, colour televisions and so forth, and these particular items are the fastest growing in adoption rate. The other thing that is linked to that is the growth of 4G networks. Now, the way that this is actually being rolled out has been very slow up to a certain point in time, but now the two coupled together are actually having a major impact, not just in terms of modern developed societies, but those are emerging economies. Usually those cited are the emerging economies of China and India, but in fact the highest growth rate is in Africa. This is coupled to a low level of IT knowledge, and security integration into the networks isn't there at this point in time, creating new exposures.
As we've said, in terms of cyber threats and their future impact, the rollout globally of 4G networks will also change the security landscape. Where bit rates will be the same as for more generally used wired and Wi-Fi networks with 100 plus megabits per second, these new wireless networks facilitate the same capability as the traditional ones. The differences between the legacy and new networks, however, lies in the predominance of smartphones and tablet computing, with all the major brands now selling tablets with the same computing capabilities of most laptop computers. Allied to this is the concurrent shift of applications to the cloud environment, with the security implications we just described. Since 4G will be the universal network globally at some point, the ability to develop and deploy and distribute attack tools, viruses and hacks will increase at a rate that has yet to be determined by security companies. The number of variables is such that any early meaningful assessment and evaluation is likely to be incorrect to an order of magnitude that renders such figures pretty much meaningless. In terms of data routing, 4G may change the traditional transport layer operationally in order to eliminate any latency. So that's to say that all packets are going to be routed in one particular direction, but determining the source and destination will still be complex in the extreme, where this is used to evaluate threat sources and volumes. In more recent times, there's also been a change in the use and licensing of software that has had a major security implication, and this has been linked with the fall in the cost of computing power and has resulted in an insidious increase in criminality due to the increasingly attractive value proposition that cyber attacks have, since the cost of computational power and a lower requirement for high levels of expertise to execute an attack, and a lack of ability for policing of existing international laws and therefore a lower probability of capture, makes it increasingly attractive to this segment. So if we combine all these new variables into the existing cyber network threat, it's clear that attack incidents has a high probability that it will increase and impact in a different pattern to the historical trend and patterns. Given this being so, companies will look to see how they can manage their cyber risk exposure across three fronts: technological security, organizational security, and risk financing mitigation for their overall risk exposure. So,
now we've reviewed how we may derive a network value at risk for a corporation, we need to start thinking about non-technological modes of risk mitigation and risk exposure. Now, there are many forms of risk financing available, such as alternative risk transfer, and that's beyond the scope of this particular presentation. So we'll keep it simple and we'll use cyber insurance as a prime example. Now, insurance has two components which determine pricing. That's probability and possibility. And the easiest way to picture this mentally is, say you're a state insurer in the state of Florida. You may wish to insure all the cars or none of the cars. It depends upon the risk exposure and the probability and possibility. If there is a major pile-up and you've insured 10% of the state's cars, it's possible that every single car in the pile-up has been insured by your corporation. The probability that that's the case is pretty low. So your company will be willing to insure up to, say, 10% of the total car population of the state of Florida. If it was later to be found that the number of wrecks in the pile-up on the interstate was much higher, then you may want to reduce the risk capacity of your corporation by reducing the percentage of cars you're willing to underwrite. And the same applies to cyber insurance.
Modelling the average or expected cost from a virus or hacker attack is very useful information for a company, obviously, but there are a number of reasons why one would want to look at a whole range of outcomes. Some of the most important of these are the use in capital modelling, use in pricing of insurance to counter the cost effects of such attacks, and also for carrying out a cost-benefit analysis for improving network security. IT-related risk form part of an organisation's operational risk capital requirements for insurance. In the case of certain industries such as financial services and banking, this, as we said previously, is a mandated percentage of risk exposure. Broadly speaking, the capital to be held for a risk is the value for the 1 in 200 year event, although overall capital is significantly reduced by diversification between different risks. Therefore, an algorithm needs to be able to predict the potential variability in costs so that this cost can be assessed. In general, insurance is priced at a margin above the expected claims, with the margin being in part related to the extent of the risk. Two risks with the same expected loss may attract very different insurance premiums if they exhibit very different characteristics in terms of variability of claims, and therefore any algorithm used in modelling needs to predict this variability in order to determine insurance pricing. Here we're looking at the revenue and claims charts for a Norwegian and a US insurer. For the chart on the left, it's easy to see that since 2006 this particular company has enjoyed a high margin threshold with a slight event payout in 2007 before the claims ratio returned to being fairly steady around the 40,000 million kroner mark. The chart on the right is for a much shorter period of time, 1 year. Here you can see the volatility for both revenue and losses. As long as the sum of the year's revenues exceed the year's claims, then the company will remain in this particular product line. Insurance and reinsurance doesn't work in the same way as the majority of commercial organizations work. This is because the industry works according to a cycle that's more akin to the chart on the right than the chart on the left. If we took a 10-year period, the volatility would be more like the right-hand chart for most insurance companies with multiple product lines. Here's another representation of the claims ratio, and the thing to note are the tabs across the top that will show the company's risk manager or the team the total exposure summary and also the reserve summary. This latter is particularly important since it's necessary to hold sufficient capital reserve to cover unexpected events. At the same time, there's a need, as with any company, to ensure the optimal use of capital in order to maximize profitability and to be competitive within the sector. To facilitate this trade-off, insurance companies will insure part of their total portfolio through reinsurers. The reinsurers will do the same thing by using a retro insurer to hedge part of their product line portfolio risk. For cyber insurance and cyber threat risk financing in general, the risk exists that in the case of a widespread successful cyber attack, the normal insurance hierarchy creates a surplus at the lower end of the tiers rather than at the top, which is where the disproportionate percentage of the loss will impact. If there are a large number of secondary retro companies which each write proportionate shares at the earlier levels in the hierarchy and have the same limits and retentions for their retro protection, then there is a risk of a spiral, since there is a higher than usual probability that there has been an unwitting inclusion of retrocession business arising from direct insurance accounts. To hopefully make this a little clearer, this slide shows the relationships between the insurance companies, the reinsurers and the retro insurers. If you think back to the financial crisis of 2007-2008, the market seized, the entire market seized because nobody knew what was in the products being sold, and so no bank wished to increase its risk exposures, and so geared credit derivatives became something that stopped credit flowing between the banks. The problem was caused by packaging of different components with varying risk into a single component, sometimes generated by one division in the bank and sold on to another division in another bank, and then the originating bank bought some of the product or all of the product back again. This is the same as in a retrocessional spiral. The reinsurers and retroinsurers basically insure part of a risk portfolio that they've already insured at another level. Retro spirals tend to occur with major events such as Piper Alpha explosion or natural disasters causing a huge number of claims simultaneously. For the case of cyber insurance, the implications are that with a single event, a low impact, high volume attack, the interconnectedness of insurance and reinsurance markets globally may lead to excessive exposure from contracts covered by reinsurers at the same level as themselves or at a higher level, which will then feed the exposure from those contracts back into their own retrocessional protection, causing a spiral. As with our earlier example of car insurance, the capacity or even the willingness of carriers to offer cyber policies or risk financing to cover cyber and network attacks may therefore diminish or even disappear over a period of time. The policy implication of all of this for governments and regulators too is what to do to ensure that mitigation financing does not dry up, since in its absence companies may need to hold higher capital reserves and thereby reducing profitability and impacting national GDP growth. The answer to that time will only give us, I would guess.
We're now at the conclusion of this short series of presentations on cyber threat management. I hope that having viewed them they can be of use to you, and the understanding of the basic principles of risk management and cyber threat management can be of use to you in your future. This is Philip King Wilson, and thank you for watching.